Hello, everyone. Today on the Final Bar, I'm talking with Sam Burns from Mill Street Research. We'll talk about this market environment netting out to a positive move. The S&P chopping around through much of the day, bouncing off 4,500 to push above 4,520 into the close. Some of the cyclical sectors, things like materials at the top, financials, then consumer discretionary. Overall, sort of a risk-on sort of feel here. Toward the end of the day, higher rates, the big story. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, the technical toolkit to better quantify investor behavior, better try to make sense of what's happening around us as investors. Sort of a choppy feel to the tape again today, similar to what we saw yesterday. At the end of the day, it's all about connecting the short-term volatility with the long-term trends. Did we answer any long-term questions today? I'm not sure, because overall, I feel like we, just barely sort of eclipsed the highs from yesterday. At the end of the day, we sort of closed at yesterday's high. We're still sort of settled into that range. We're in that no man's land between two moving averages, between the 50-day, between the 200-day, not strong enough to get back above the 50-day, make new swing highs, push on back to all-time highs around 4,800, not weak enough to go below the previous, below the 200-day moving average, below the previous swing lows, and retest those lows from recent weeks in the last couple months. So overall, we're sort of in that sideways choppiness of the markets, and we'll wait to see which side buyers or sellers actually take control. I'm excited to talk to Sam Burns from Mill Street Research in a little while. He does a great job of helping us make sense of timeframes like this, I would say. Great guests again, the remainder of this week. Tomorrow, we have technical analyst Carolyn Borden joining us for the first time on the show. On Thursday, the 10th, Ryan Dietrich from LPL Financial. Coming up next Tuesday, Jay Sola from Investors Alley joining us on Tuesday, the 15th. Also, just to remind you, our next Money Show Virtual Expo is actually going on tomorrow. Greg Schnell and I, fellow StockCharts contributor, we will be presenting a session called Trading Cannabis Stocks Using Price Momentum. This virtual expo is all about cannabis names and different ways to approach them. We will be doing a very technically oriented session, as you could probably imagine, talking about price momentum. Honestly, the relatively weak price momentum characteristics you see in some of those tickers like MJ and others, but how that relates to some of the stronger charts in agriculture stocks, for example, what we would need to see in the cannabis stocks to turn a little more bullish. That's tomorrow, the night, 2:30 p.m. Eastern. You can sign up for that event at stockcharts.com/moneyshow. Let's continue on today's show with our market recap. We're going to start here with a poll. We asked you recently on our StockCharts TV live stream page, also on our social media accounts. You decide you're bullish, then you start looking for evidence to support your thesis. Which behavioral bias are you demonstrating? I feel very confident and validated that most of you, 9 out of 10 of you almost, answer that correctly. That is indeed confirmation bias. I would say by far the most prevalent behavioral bias that you find in the financial markets and even in the financial industry. As professional analysts and money managers, it is very easy to fall victim to that very, sort of primal instinct to validate a decision you've already made. We very often will make the decision and then try to gather evidence to really make ourselves feel better, to nurture our ego and feel better about that decision we've made. What you want to do is gather the evidence first and then make the decision. So do not fall victim to confirmation bias. I would argue looking at charts consistently is one of the great ways to minimize the impact of confirmation bias on your decision-making. Let's continue on with our market recap here. As I mentioned, a choppy session today. We finished near the highs of the day and really pushed just right into the highs of yesterday, right around 45.20. The S&P closing just above there. That's 0.8% above yesterday. The NASDAQ composite up 1.3%. So a nice recovery day there as well. Mid caps and small caps outperforming the large cap index with the S&P 600 small cap index up 1.8%. The VIX is pushing back down toward 20. I was asked earlier in the year, early January, about the VIX, and one of my points was I believe that the VIX will probably spend more time above 20 than below 20 in the year 2022. So far, that's been the case. We're getting close to that level again as volatility has come off just a little bit. It doesn't feel like a lack of volatility in a tape like today, but that is what the data would suggest. Interest rates pushing higher with the 10-year yield getting up to 197, very, very close to 2%, which we've not seen in quite some time. We have now handily eclipsed the highs from 2021, arguably pushing above or pushing toward that 2% level, if not further. And some of my recent guests, we've talked about interest rates. Never confuse the top of the page with resistance is what I would tell you about interest rates. They've gone much higher than they were, a year ago, a year and a half ago. There's no reason why they can't go further to the upside from a technical perspective. There's certainly plenty of room on the charts, and I would certainly be thinking about what higher rates most likely mean for you and your portfolio, where you're sort of weighted there, because certain types of names tend to do better than others in a rising rate environment. Gold and silver higher, although most of the energy, most of the commodity complex, lower, including energy prices. Oil prices down quite a bit with the USO. It's a proxy for crude oil prices down about 1.7%. The energy sector, very clearly underperforming the rest of the S&P sectors. Only 3 S&P sectors in the red here as we're processing closing data. Energy down over 2%, REITs down 0.9%. Communication services really flat for the day. And everything else was positive. Cryptocurrencies ended up about mixed, although there's a nice run higher here in the last little stretch of time as we're getting ready for the show. Bitcoin pushing just back above 4,000. Ethereum, pushing a little bit lower, but remaining above 3,000, which is a key big round number we've talked about. Actually bounced off of 3,000 as a support level yesterday. Chart of the S&P here very quickly. We'll refresh the chart to lock in the closing price. We finished near the highs of the day. Interesting, you could call today a bullish engulfing pattern, although it's not my favorite example of that, because what you really want for a bullish engulfing pattern is to have a clear downtrend, right? In a downtrend, you have a bullish engulfing pattern that shows a reversal from negative sentiment or bearish momentum to more bullish momentum. A bearish engulfing pattern you'd want to see during an uptrend, right? A strong uptrend, and then you get an engulfing pattern. Here we're sort of chopping around in no man's land, as I mentioned. We're sort of in the woods, in the wilderness here between recent swing highs and swing lows. This week so far, we've not had any real directional movement outside of the range we established last week. Last week was when we bounced off of the lows around 42.20. We settled into this range, and again, on that tactical time frame, we're settling in between 2 Fibonacci levels. The 61.8% level is around 45.90, the 38.2% level around 44.50, and that's using the January high and the low as the extremes there. So it's interesting that we've actually settled in and bounced off of support and resistance, sort of as expected, using those extreme levels. Now, if you look around you on the chart, you will find that we're just below the 50-day moving average, and we're also just bouncing off of the 200-day moving average. So, if you're bearish, which I would certainly count myself in, if I had to pick bearish or bullish, I'd probably lean more bullish, just given the deterioration we've seen on a lot of memetics, momentum and breadth and otherwise. You really need to see a break below 44.50. That would take us back below the 200-day moving average, below the 38.2% retracement level, below the lows from last Friday. That would, I think, validate higher likelihood of retesting those swing lows, at least down to 4,300. That's where we essentially bounced off of in mid to late January. If you're bullish, I would be looking for a break above the swing high from last week, right? Higher low, that would mean that we then have a higher low and then a higher high. And once we complete that pattern, you'll hear me start to get a lot more constructive about the possibility of regaining 4,700, if not 4,800, and pushing back to the highs from the beginning of this year. So really, I think we're sort of in wait and see mode. Of course, we have a lot of potential catalysts with earnings this week, right? So plenty of names kind of coming out today after the close. We have names like Peloton, Enphase, Lyft, some widely followed names. Yesterday, you had charts like Amgen, Take-Two, with pretty big earnings. And just to wrap up our market recap here, Biotech's an interesting space. We talked about, I forget which name actually we talked about yesterday or on Friday's show. We mentioned one of the biotech stocks and it's escaping me, but an uptrend is a pattern of higher highs and higher lows. Amgen, if you look at it on an absolute basis though, really hasn't gone anywhere. If we take the dividends out of the picture and just look at the unadjusted price data, a couple of weeks ago, we're literally at the midpoint of where we've been. If you take the March 2020 low, the January 2020 sort of intraday spike, or even the highs from earlier in 2021, we're sort of right in the middle of that range. The moving average is relatively flat. Today, we gap higher, which is significant. Getting above a key resistance level is important. Staying above that resistance level is even more important. So as we digest the gains from today, I would argue remaining above 235 is a pretty important level. It's always interesting to see a breakout and then we hold above that level. Look at the bottom here in Amgen. When you had the high in November, we made a new low, we broke above that level. And then look at a couple times we retested that 220 level again before rotating higher today. So it's all about breaking out, I would argue, and holding those breakout levels on Amgen. Be very keen to see after the move higher today, do you get follow through, right? Do you push higher, get above 245, 250? Those would be the most recent swing highs from July of last year. And can we make sure we establish higher lows? We hold those breakout points around 235. I'll be looking there. It reminds me of charts like UPS with nice breakouts and so far holding support. Let's see if that can be maintained. We need to take a quick break here. We'll be back with today's guest, Sam Burns. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the market action, try desperately to connect the short-term movements, the flickering ticks, the noise of the market, and relate those to the long-term trends. I'm excited to talk to my guest here in a few moments, Sam Burns. He does a great job of thinking a little more long-term about where we should be focused. I'm very keen to get his take on this market environment. A couple quick comments before I bring Sam on. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and we'd love to feature one of your questions in our next mailbag segment on Friday's show this week. You can email us any of your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and we'll hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. It is totally free. You use your email address to set up a free account. Great guest interviews like Sam Burns and many others. Special events like our Outlook that was in January featuring people like Larry Williams and Martin Pring and others. So much more content every trading day. Go to StockChartsTV.com or on your mobile device, just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Sam Burns. Sam is the founder of Mill Street Research, coming to us from the Boston area. Sam, it's good to see you. Happy New Year. Welcome back to the show.
Hey, Dave. Thanks for having me on. It's great.
So obviously sort of a choppy feel, January was fairly painful for a lot of investors. Now we're sort of settling into this range. You're starting us with a bit of a look at sentiment, looking at investors' intelligence. What are you seeing here?
Well, I think the interesting thing here about the sentiment data in particular is how bearish all the respondents here have gotten when the market, at least as measured by the S&P 500, hasn't really pulled back that much relative to what we might have seen in past times when sentiment got this bearish. We barely touched a 10% correction in late January and have since bounced. So we're not even down that much now. We've already seen a big drop in the bulls relative to the bears in the Investors Intelligence Sentiment Survey there, and the sentiment looks a lot more like a bigger correction would have already occurred. It'd be more typical of a 15% or more correction to see this kind of pullback and bullishness. So it tells me that people are pretty sensitive to to jumping off and getting bearish, getting cautious at least. That they're responding to the first hints of trouble to go ahead and get bearish. And I think I have some ideas about why, but I think that's the key theme from this chart.
Investors have been hurt before, it seems like, right? We're very quickly to get nervous when the market's coming off as it has. Now, obviously, a lot has been discussed about just leadership themes. Last year was very much a rotational year, sort of growth, value, offense, defense. Take us through what you're seeing now, where you see leadership. What are your trends here on chart 2?
Yeah, so this is more evidence of that rotation, and it's become even more aggressive recently. The leadership, into sort of March 2021, about a year ago, was definitely the small cap growth space. Even some of those ARC type names, the really aggressive small cap growth names. And so much to the last year or so has been a rotation away from those small cap growth names and towards large caps in general, and specifically large cap value, particularly more recently. I think that's been the rotation the last few months. And so if you're looking at a large cap value index, you're only a couple percent off the highs and you're probably pretty happy. You're up 20 odd percent close to it from a year ago, and there's no reason to be bearish. If you're looking at small cap growth stocks, by contrast, and certainly the kind of the ARC type names, they're the most aggressive areas. You're down 20, 30, 40%, and you certainly have a lot more reason to think bearishly. So I think these gaps, these divergences in the styles are part of the reason why we're seeing sentiment move the way it has. And certainly, if you own any of these kind of small cap growth stocks, that would certainly explain why you're more cautious. So I think it's more of a large cap environment now. I think it's more value oriented. I think that's typical for where we are in the economic cycle, with the Fed looking to be raising rates soon, and a lot of that excess liquidity that was there in 2020 and 21 is now starting to be pulled back. And this is kind of what you typically see in those environments.
It's a bunch of great points in there, Sam. And when I think I know hearing from a lot of individual investors, there's certainly a thought when some of these growthy names, particularly the smaller names, some of the ARC names, are down so much, right? And thinking of like solar stocks, and we talk about end phase and a market recap, and they're down pretty significantly from highs. And it's super tempting to get in and think, all right, perfect. Now's the chance to ride the obvious next leg higher. Given the environment, and I know you're not a pure technician, you've got a lot of different things you're looking at. What do you look at opportunistically when you have energy and financials, arguably the two strongest sectors, but they've had a pretty good run, of course, versus some of the growth stuff that's beaten down? Is this a time to play some of that mean reversion, or do you stick with what's working given the broader tailwinds in the market? Where are you looking now?
I think, yeah, to some degree, you want to kind of stick with what's working. I think if you were going to, take some profits in the large cap value areas, the energy and financials, that you might want to go into more kind of a large cap growth, technology sector, that kind of area, that'll probably hold up better than, say, the small cap growth. I think some of those, really, really big momentum stocks that have broken down, typically they don't come at least back to where they were. Once they've kind of broken after such a big move, and as the liquidity environment changes, it's hard to get them to really come back the same way until you've had another kind of full cycle pass. So I think you're going to see more rotation between large cap growth and value as leadership, and probably less so from the small caps, and particularly small cap growth.
We only have about a minute left, Sam, but I'd love to think, obviously, we're sort of getting through earnings season here. We had all the, FANG stocks really reporting in the last couple of weeks. Any surprises or any key takeaways from you? Did this change your perspective on anything as you're thinking about the potential health or lack of health of the market? Or what's your takeaway as we wind down earnings season here?
Earnings season so far has been pretty good. We've had the majority of stocks beating estimates and giving reasonable guidance. Not like we had, in the last year or two when it was just pretty much all beats and raises. Everything was good news. I think now analysts have kind of caught up to where we are, and I think the economic backdrop is a little more balanced. So we're seeing a much more typical kind of proportion of good news and bad news from companies. I think most of the key companies came in okay. There were obviously weakness in things like Facebook or Meta, and a few of the banks disappointed. But overall, I think earnings in general are going to hold up pretty well. I think we get decent growth this year. I think that'll help put a floor under equities in general, even with rates moving up. As long as rates are going up because the economy is still strong, then I think stocks do okay. And certainly, if you look at how how stocks have done relative to bonds recently. If you look at the kind of the SPY versus TLT ratio, it's basically right back up to its highs now. So it's still a stocks over bonds environment, and not as much of a risk off environment as you might think looking at some of the small cap growth stocks.
I appreciate it, Sam. It's so great to talk to you. Love your take on things, and thanks for helping us make sense of these choppy markets. Sam Burns from Mill Street Research. Thanks again for coming on today.
Thanks a lot, Dave.
That's Sam Burns. Sam's the founder of Mill Street Research, coming to us from Boston. What a pleasure to talk with Sam and just get his take on what's happening with all of these movements that we've seen. It's so easy, I know, for me and many, looking at the markets every day and staring at what I call the flickering ticks, the short-term movements. Sam does a great job sort of laying out sort of the longer-term perspective and how to make sense of these trends and how they're evolving. I love that chart looking at the performance of some of those different sleeves of the market. Great reminder of how much things are getting differentiated here for sure. And 2022 so far continuing that process. Great take there from Sam Burns. Let's continue on today's show with our final bar mailbag. As a reminder, all of our questions come from all of you, and we appreciate you sending in your questions. The final bar at StockCharts.com is our email. Let's get to question number one. Using stock charts, there are two types of solid candles in a Heikin Ashi chart. Great question. It's a traditional Japanese form of technical analysis, very similar to candle charts if you've not heard of them. I would appreciate if you could help me understand the differences between black and red solid candles. Yeah, absolutely. So let's bring up a random chart here. So we're looking at Amgen. What we need to do is go down to the bottom and say chart type, and we change it to Heikin Ashi, which is this one here. It looks a lot like a candle chart. So depending on how you how familiar you are with candle charts, it may look very familiar or may not. This is probably what your chart looks like. This is using the traditional coloration for our charts. And I'm going to look at just the last year on here. So you have a series of candles, and don't worry about what Heikin Ashi charts mean relative to candle charts. Just think of it like a candle chart because the colors mean the same thing. You basically have solid candles and clear candles, right? The clear candles mean the close is above the open. The solid candles mean the close is below the open on candlesticks and with this type of chart as well. The whether or not the bar itself is red or black is where the close is today versus yesterday's close, right? That last point. So, and maybe, I'll take it off of a Heikin Ashi and actually just make it a regular candle chart because it'll probably make sense to many of you, and the interpretation's kind of the same. So this might be a little more familiar look, open, high, low, close. And the clear candles mean you closed above the previous day's open. A solid candles mean you closed below the previous day's, or below the current day's open. The red and black color of the entire thing, whether or not it's an open candle or a closed candle, is today's close versus yesterday's close. So you can see a clear candle, but it's red. It means the close is above the open, but the whole day's close is below the previous day's close. A solid, let's see, like a solid black candle mean you close below today's open, but it's above yesterday's close. So between the color and the shape of the candle, where it's solid or open, you can tell two important pieces of information: where the close is relative to today's open and where the close is relative to yesterday's close. As you notice, when I change it, I actually don't use those colors because I find it a little bit confusing, which is what you probably you picked up on as I'm trying to explain these two. I actually look at my candles like this. I ignore that color scheme and just look at whether they're open or closed, whether they're solid or open candles, because that tells you about the close versus the open. Traditional candlestick analysis, that's kind of how it's done. And so for me, I really don't use those color codes, but that was a way that stock charts and other platforms that do that sort of thing, just a way to try to use color as an additional data point overlaid onto the price action. If that's interesting to you, by the way, I'm thinking of the Elder bars, like Alexander Elder takes that to 11 and goes to another level of using those sorts of color schemes overlaid on the stock price. Next question. On the chart of SRTY, I see what appears to be a golden cross, but the RSI is declining and the PPO doesn't look promising. Conversely, on the IWM, you see the opposite combination. How do I make sense of this? So SRTY is basically a short, it's an ultra short Russell 2000 ETF. So it's sort of like the IWM flipped up. So I think what your question is you're seeing a bullish, you're seeing a golden cross on the first one. So here you're seeing a death cross or a dead cross where the 50-day is crossing down through the 200-day, but you're starting to see improvements in trend and momentum. So how do you recognize those two? So that honestly is one of the reasons why using the golden cross and the death cross, using the 50 and 200-day moving averages is not a great trading system. And if you backtest using the 50 and 200-day moving averages, it's not great. It's great if there's a really long-term trend. So if you look at like the S&P in the 90s through the mid 2000s, you'll find it's beautiful because there were these big cyclical turns. But once the market gets more choppy, a little more nuanced, it's going to almost give you the wrong signal 100% of the time. So it's going to give you a buy signal when the market's just topping out, and it's going to give you a sell signal when things are actually bottoming out because of how lagged those are. The MACD, the PPO are really designed to be short-term trend indicators. So what would normally happen is the PPO would give you a sell signal when the trend is starting to reverse. These 50 and the 200-day are going to take quite some time because it lags so much behind the price movement. You're giving a really good argument for using more of a trend-based adaptive indicator like the PPO, which is based on exponential averages, which tends to track things a little bit better. 50 and 200 days is just a really long-term time frame. That's why I rarely on the show mention golden crosses or death crosses, just because I'm not a huge fan of them. Final question, then we have to wrap. What are your thoughts on the reliability of RSI and indicator divergences from price, and how reliable are they at forecasting future weakness? And you included these two charts, the DBA and the ZIM. So my short answer is I think they're incredibly valuable. And we've talked about on the S&P 500 chart, the fact that the S&P went higher in November, December, January, and the momentum sloped lower is a concern. I think that lack of momentum confirmation is actually a big concern. What I don't agree is that the chart of DBA is showing a bearish divergence as you're implying, and I'll tell you why. The challenge is if you're looking at a divergence and you're using the current bar, you're making a mistake. You want to wait until the top is actually formed. You want to wait till the DBA is actually rolled over, because then you've confirmed a high. Right now, it's an active trade. It's actually going up right now. So you can't call it a divergence, because by the time this trend is over, this may not be a divergence anymore. You want to look for when a peak has happened, and you can compare this peak, this price peak, to the previous price peak, and then look at the breadth conditions underlying that. At this point, I wouldn't call that a divergence yet, because this is still an active move. Price is still going higher. Wait until the price peaks out, then look to see if that divergence still stands. Then you have a concerning momentum divergence. My YouTube channel, by the way, I go through that in a lot more detail than we have ever chance to on the show. We need to wrap today's show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the financial sector. My guest, Sam Burns, was mentioning higher rates. We talked in our market recap the fact that 10-year yield is getting near to that 2% level, a level just unimaginable not too long ago, but very much in a rounding error away from the current price levels. Stronger yields, higher interest rates tends to be gooder for certain sectors, value-oriented sectors, particularly things like financials. You can see the XLF overall threatening to make a new all-time high, but not quite there on a relative basis, breaking above its October high and very close to making a 12-month new relative high. I think that's a sector showing some emerging signs of strength after bouncing off of support around 37 on the XLF, bouncing off the 200-day, rotating back to the upside. This is a sector that should do pretty well if rates and the Fed do sort of what they're implying. And I think there could be some good further opportunity there. And I'd look there if you have not as well. Use the scooter rankings to find some of the better ranked names. Offense versus defense, we use consumer discretionary versus staples. It's a classic way of seeing where investors are leaning on the offensive side or defensive side of the consumer sector. Recently, in the last couple of months, it's certainly been faring defense over offense. If you look, the ratios peaked out in November on a cap-weighted and an equal-weighted basis, making new swing lows. But in the last couple of weeks, sort of choppy. I'd be very interested to see which way these resolve. Overall, I think the benefit it out has to be given to the defensive side, given the fact that that's the larger trend. Do we make a higher low in those ratios? That would tell me that the sentiment is starting to shift more on offense. Finally, I mentioned UPS earlier in the show just briefly. The break above 220, the gap on earnings last week was significant. Charts like this holding their breakout level can tell you a lot about the underlying strength in the equity market. So it hit initially 220 back in May of last year, hit resistance there again in October of last year, January of 2022. We gapped right above that level, and we've stalled a little bit. Can we hold 220? If so, this is a pretty good chart, a nice base breakout with upside potential. If we fail, That's a big concern for UPS and for the broader markets. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Sam Burns from Mill Street Research. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.